Welcome to Belhaven University Lectures. What you are about to hear is a podcast based on course material selected by the course developer. It was generated by Google Notebook LM, a generative AI. Please contact your instructor if you have any questions related to the content. Okay, let's get started.
Welcome to this deep dive. We're drawing directly from Belhaven University course materials today. Think of this as your curated guide to understanding the often complex world of property transactions, specifically how the tax code treats gains and losses when you buy and sell various types of assets. Our mission today is really to demystify capital gains and losses, and then we'll navigate the nuances of Section 1231 and depreciation recapture. We'll break down what these concepts mean for your tax picture. We'll start with the fundamental rules for capital gains and losses, what they are, how they're categorized, and, well, why it all matters. We'll also clarify the crucial distinctions between capital assets and other forms of property, like maybe the assets you deal with regularly in a business. From there, we'll look at the necessity of a sale or exchange for recognizing these gains or losses, and we'll also highlight some interesting exceptions to that rule, things like worthless securities, options, patents, franchises, even lease cancellation payments. Finally, for this first part, we'll tackle the holding period, how long you own an asset, and why that can dramatically affect how your gains are taxed. So, let's get started laying that groundwork.
Indeed. Let's begin by establishing the general framework for how capital gains and losses are taxed. It's important to recognize right off the bat that the tax treatment is distinct. This is mainly because of the potential for more favorable tax rates on long-term capital gains compared to ordinary income, and also the specific limits on deducting capital losses. For individual taxpayers, like non-corporate taxpayers, the deduction for net capital losses is capped at $3,000 per year.
Okay. Against ordinary income.
Against ordinary income, yes.
Yeah.
And any remaining loss gets carried forward to offset future capital gains or even that limited amount of ordinary income in later years.
Okay, so it's definitely not as simple as just adding up profits and subtracting losses. The code has these specific rules that can really impact your bottom line. As you said, understanding these rules hinges on a few key things about the property itself.
Precisely. The correct classification of any gain or loss really depends on three core characteristics. First, we need to figure out the tax status of the property. Is it a capital asset, a Section 1231 asset, which we'll get into later, or just an ordinary asset?
Right.
Second, how did you dispose of it? Was it a sale, an exchange, or maybe something involuntary like a casualty theft or condemnation?
Okay.
And finally, the third crucial piece is the holding period. How long did you actually own the asset? More than a year is generally long-term, a year or less, that's short-term.
Got it. So before we even crunch numbers, we have to ID the asset type, how it left our hands, and how long we had it. Makes sense. Now, let's dive into that first category. What exactly counts as a capital asset for tax purposes?
Well, Section 1221A of the Internal Revenue Code defines it mostly by listing what isn't a capital asset. And the list is pretty comprehensive. It includes things like inventory, property you hold primarily for sale to customers in your business.
Okay, standard business stuff.
Exactly. Also excludes accounts and notes receivable from selling goods or services. And interestingly, depreciable property or real estate used in your trade or business, that's generally not a capital asset, though there's an exception for self-generated goodwill. Certain intellectual property is also out patents, inventions, copyrights, artistic compositions held by the creator.
The creator specifically.
The creator, or certain people they give it to, yes. Also, some government publications you got cheap and supplies you use up in your business. Notice how this list mostly covers assets used in the ordinary course of business. The tax code generally wants to treat profits from your regular operations differently from investment profits.
That's a pretty big list of what doesn't count. So if something's not on that list, is it usually a capital asset?
Generally, yes. Capital assets usually cover things held for investment stocks, bonds, land held for appreciation. Also, personal use assets. Think your house, your personal car. Those are capital assets too. And Congress can specifically designate other things as capital assets. But sometimes the lines get blurry and judicial interpretation is needed to clarify if something fits the definition or the exclusions.
And the materials mentioned statutory expansions. What are those about?
Right. These are specific rules Congress added for clarity. For example, securities dealers usually hold stocks as inventory, right? Ordinary assets. But a dealer can identify specific securities as held for investment on the day they buy them. If they do that properly, the gain or loss on those specific securities becomes capital.
Okay, so they can earmark some for investment treatment.
Exactly. Another one is Section 1237 for subdivided real estate. If you're not normally a real estate dealer and you subdivide a tract of land and meet certain requirements, you can get capital gain treatment on selling the lots, at least up to the 6th lot sold.
Interesting.
And finally, non-business bad debts loans you made outside your business that go totally worthless, they're treated as short-term capital losses in the year they become worthless, even if the debt was old.
Got it. So these expansions sort of fine-tune the definition in specific cases.
Precisely. They help clarify the boundaries.
Okay, let's shift gears. You mentioned the manner of disposition. Let's talk about the sale or exchange requirement. Why is that usually needed for a capital gain or loss?
Well, the general rule is that you need a sale or exchange of a capital asset to trigger a capital gain or loss. The code doesn't strictly define sale or exchange, but generally a sale involves getting money or having debt assumed.
Right.
An exchange is more like a swap trading property for other property. It's important to note, though, that involuntary conversions like damage from a fire or theft or government condemnation, those usually aren't considered sales or exchanges for this purpose. They have their own set of rules.
But the outline flags some exceptions to needing that actual sale or exchange. That sounds like an area where you could easily get tripped up.
It definitely is. There are several key exceptions. One big one is worthless securities. If a stock or bond you own becomes completely worthless, the tax code treats it as if you sold it on the very last day of the tax year it became worthless.
Ah, so you get the loss even without a buyer.
Exactly. It allows you to recognize that capital loss. Another exception is Section 1244 stock. This lets individual taxpayers treat losses on selling stock in certain small businesses as ordinary losses up to annual limits.
Which is better than a capital loss, usually.
Often, yes, because ordinary losses can offset ordinary income directly without that $3,000 limit. Also, if a corporation retires its bonds or notes that you hold, that retirement is treated as a sale or exchange.
Okay. What about more complex things? Options, patents, franchises, how do they fit in?
Right, options have their own rules. If you hold an option and sell it or let it expire worthless, your gain or loss is typically capital. If the property the option was for would have been a capital asset for you.
Makes sense.
Now, if you wrote or granted the option and it expires, you generally have a short-term capital gain if the option was on stocks, securities, or commodities.
Yeah.
If it was on something else, the income is ordinary.
Okay.
If the option gets exercised, the premium you received for writing it basically adjusts your proceeds from selling the underlying asset.
Got it. And patents.
For patents, if a holder transfers all substantial rights, it's treated as a sale or exchange of a long-term capital asset. A holder is usually the inventor or someone who bought the rights from the inventor before it was reduced to practice.
So selling the whole patent gets long-term capital gain.
If you're a holder, yes. Now, franchises, trademarks, trade names under Section 1253, that's often different. Licensing these usually isn't a sale or exchange, and payments are ordinary income. Unless you transfer all significant powers and rights and don't keep a continuing interest, then it might qualify as a sale. The rules get complex depending on whether payments are fixed or contingent and what rights are kept.
Okay, tricky. And lease cancellations.
Depends if you're the lessee or lessor. If you're the lessee getting paid to cancel, it's treated as an exchange. The character depends on your use. Personal use is capital gain. Business use, lease 1 year is ordinary income. Business use, lease 1 year is Section 1231 gain, which we'll get to.
And if you're the landlord, the lessor.
Always ordinary income for the lessor receiving the payment. So yeah, lots of specific rules carving out exceptions or special treatments under the sale or exchange umbrella.
That really highlights the complexity. Okay, let's move to the holding period. Why is the length of time you own something so critical?
The holding period is absolutely fundamental. It dictates whether your capital gain or loss is short-term or long-term. Short-term is 1 year or less. Long-term is more than 1 year.
And that matters because?
Because, as we touched on, net long-term capital gains generally get taxed at those lower preferential rates, 0%, 15%, maybe 20%. Net short-term gains are taxed at your regular, ordinary income rates, which are usually higher.
Big difference. How's it calculated? Is it exactly 365 days?
It starts the day after you acquire the property and includes the day you dispose of it. It's based on calendar months, not strictly days. So, buy May 1st, sell on May 1st, the next year, that's exactly 1 year, short-term. Sell on May 2nd, that's long-term.
Okay, day after acquisition, up to and including disposition day. Are there special situations affecting this?
Oh yes, several special rules. In a non-taxable exchange, like a like-kind exchange, if the asset you gave up was a capital or Section 1231 asset, its holding period usually tacks on to the new asset you received.
So you don't restart the clock.
Right. Same idea with gifts. If you receive property as a gift and you use the donor's basis, you also generally get to include the donor's holding period.
Okay.
However, if a loss is disallowed, say, you sell to a related party or sell a personal use asset at a loss, the holding period doesn't carry over if you repurchase or acquire similar property.
Got it.
And a really important one, inherited property. Property you inherit is always treated as held long-term, no matter how long the person who died owned it or how long you've held it since inheriting.
That's a key point. Always long-term for inherited assets.
Always. And then there are specific, quite complex rules for short sales, selling borrowed stock designed to prevent manipulating holding periods.
Okay, so we've covered what capital gains and losses are, the assets, sale exchange need and exceptions, and the holding period. How does this all come together for tax calculation for individuals?
Right. For non-corporate taxpayers, it involves a netting process. First, you net all your short-term gains and losses together. Get a net short-term figure.
Okay.
Then you do the same for long-term gains and losses. Get a net long-term figure. If the overall result is a net capital loss, your deduction against ordinary income is limited, as we said, to $3,000 per year.
And the rest carries forward.
Carries forward indefinitely, keeping its character as short-term or long-term. Now, if you have an overall net capital gain, the treatment depends. If it's a short-term gain, taxed at ordinary income rates.
The higher rates.
Usually. But if it's a net long-term capital gain, that's where the preferential rates kick in. Currently 0%, 15%, or 20% for most things. But there are also special higher long-term rates. A 25% rate can apply to something called unrecaptured Section 1250 gain related to real estate depreciation, and a 28% rate can apply to gains from collectibles like art or coins and some small business stock.
So multiple long-term rates potentially.
Yes, and there's a specific ordering process for netting gains and losses across these different long-term rate categories to make sure you benefit from the lowest applicable rates first. It's a bit mechanical, but ensures the structure works as intended.
That's a really helpful walkthrough of the capital gain and loss basics. It's clear why understanding this is so crucial. Thanks for guiding us through Chapter 16.
You're welcome.
All right, let's pivot now to Chapter 17. We're going to get into Section 1231 assets and the sometimes tricky area of depreciation recapture.
Right. Section 1231 deals with a specific class of assets used in a business, primarily depreciable property and real property. Now, we just said these are generally excluded from the capital asset definition.
Yeah, you did.
But Section 1231 gives them unique treatment.
Yeah.
If you hold these assets for more than a year and meet other criteria, a net gain from selling or exchanging them can actually be treated as a long-term capital gain.
Ah, so they can get capital gain treatment even though they're not capital assets.
Exactly. And here's the other side of the coin. If you have a net loss from these Section 1231 assets, that loss is treated as an ordinary loss.
Ordinary loss. Fully deductible against ordinary income without the $3K limit.
Precisely. So Section 1231 potentially offers the best of both worlds. Ordinary loss treatment if things go badly, and long-term capital gain treatment if things go well.
That sounds pretty advantageous for businesses. What kind of assets fall under 1231?
Generally, it's depreciable or real property used in a trade or business, or held for income production like machinery, equipment, buildings, business land if held over a year. It also includes timber, coal, iron ore under certain conditions, specific types of livestock held for set periods, unharvested crops sold with the land, and some purchased intangibles like goodwill.
Okay, and what's not 1231?
Property not held long-term, inventory, property held mainly for sale, certain IP we mentioned earlier, and business receivables. Basically, the ordinary course of business stuff is still out. The key is net 1231 loss equals ordinary loss. Net 1231 gain, generally long-term capital gain, but subject to recapture, which we need to talk about.
And the materials mention special rules for things like casualties and thefts involving these assets.
Yes, there's a sort of preliminary netting for those. You take your gains and losses from casualties and thefts of Section 1231 property and also long-term non-personal use capital assets. Net those together first.
Okay, subnetting.
Right. If the gains exceed the losses in this subnetting, the net gain becomes the Section 1231 gain and gets thrown into the main 1231 pot. But if the losses exceed the gains here, then all those casualty items are treated as ordinary gains and losses, completely separate from the main 1231 calculation.
Interesting. And condemnations?
Condemnations are generally treated like other Section 1231 dispositions if it's business or investment property. Personal use property condemnations follow different rules.
Okay. And then there's the main 1231 calculation and something called a look-back rule.
Correct. After the casualty netting, you combine all your remaining Section 1231 gains and losses. If you end up with a net Section 1231 gain for the year, you then have to apply the look-back rule. This rule makes you look back 5 years. Did you have any net Section 1231 losses in those 5 years that haven't already been recaptured?
Recaptured how?
Meaning used to offset a previous 1231 gain.
Mm-hmm.
If you have these non-recaptured prior year losses, your current year Section 1231 gain is recharacterized as ordinary income up to the amount of those prior losses.
Ah, so you have to sort of pay back the ordinary loss benefit you got in prior years before you get capital gain treatment now.
That's exactly the idea. Any current year net 1231 gain remaining after this look-back adjustment is then treated as a long-term capital gain. If your overall 1231 netting results in a net loss for the year, the whole thing is an ordinary loss. No look-back needed for losses.
That look-back rule definitely seems designed to prevent timing games, trying to isolate losses as ordinary and gains as capital in different years.
That's precisely the intent. It smooths things out over a 5-year period.
Okay, that covers 1231. Now let's get into depreciation recapture sections 1245 and 1250. What's the big picture purpose here?
The core idea behind both 1245 and 1250 is to prevent taxpayers from getting a double benefit. You take depreciation deductions against ordinary income while you hold an asset.
Reducing your taxes year by year.
Right. Then, when you sell the asset, some of the gain might be due purely to that depreciation you took. Without recapture, that gain might otherwise be taxed as a Section 1231 gain, potentially at lower capital gain rates. Recapture rules essentially say, wait, that part of the gain that's just reversing prior ordinary deductions, that part should be taxed as ordinary income too.
Okay, so it claws back the tax benefit of depreciation as ordinary income when the asset is sold. Let's start with Section 1245. What property does it hit?
Section 1245 primarily targets tangible personal property used in business, think machinery, equipment, vehicles, furniture. It also covers certain amortizable intangible assets like patents and copyrights, and even some specific types of real property that aren't buildings, like storage facilities or agricultural structures. Professional sports contracts, too. Basically, most depreciable business property except most buildings and their components.
And how does the recapture work under 1245?
It's pretty straightforward, relatively speaking. When you sell Section 1245 property at a gain, you have to recapture as ordinary income the lesser of 1, the gain you recognized, or 2, the total accumulated depreciation you claimed, or were allowed to claim, on that property.
So if I sell equipment for a $10,000 gain, but I took $12,000 in depreciation, the whole $10,000 gain is ordinary income.
Correct. The entire gain is ordinary under 1245 recapture in that case.
And if the gain was, say, $15,000 and depreciation was $12,000,
then $12,000 of the gain is recaptured as ordinary income under Section 1245. The remaining $3,000 of gain would typically be treated as Section 1231 gain, assuming you met the holding period.
okay. And this applies regardless of depreciation method.
Yes, 1245 applies regardless of the method used or how long you held it, as long as there's a gain. Importantly, it doesn't apply to losses. Losses on 1245 property generally fall under Section 1231.
Got it. So 1245 often turns a good chunk, maybe all, of the gain on equipment sales into ordinary income. Now, what about Section 1250? That's for real property.
Yes, Section 1250 applies to depreciable real property that isn't Section 1245 property. So mainly buildings and their structural components. Land itself isn't depreciable, so it's not subject to 1250.
Okay. How does its recapture differ?
The key difference is that Section 1250 historically recaptured only the additional depreciation. That's the amount of accelerated depreciation you took in excess of what straight-line depreciation would have been.
Only the extra depreciation over straight line.
Exactly. But here's the thing. For most real property placed in service after 1986, tax law generally requires you to use the straight-line method.
So there's no additional depreciation to recapture.
For most buildings acquired since then, that's correct. There's typically no additional depreciation, so Section 1250 recapture often results in zero ordinary income for those properties.
So 1250 is less of a concern for newer buildings.
Much less so in terms of generating ordinary income recapture. It can still apply to older properties where accelerated methods were used, or certain specific types like some low-income housing. Like 1245, it doesn't apply if the property is sold at a loss. However, there's another twist with real estate. Unrecaptured Section 1250 gain. This isn't ordinary income recapture. It's a portion of the Section 1231 gain on selling real property that's attributable to any depreciation taken, even straight line, and it gets taxed at a maximum capital gains rate of 25%, which is higher than the usual 0.152% rates.
Okay, so even with straight line depreciation on building, some of the gain might get taxed at 25% instead of the lower capital gain rates.
Potentially, yes. Up to the amount of depreciation taken, limited by the overall Section 1231 gain. It's a specific category within the long-term capital gain calculation.
So 1245 usually means significant ordinary income recapture on equipment. 1250 means less ordinary income recapture on newer buildings, but introduces that potential 25% rate category for the depreciation part of the gain.
That's a good summary of the main difference in impact.
Now, are there ways around these recapture rules, exceptions where they don't apply?
Yes, there are several important exceptions common to both 1245 and 1250. Gifts are a big one. If you give away depreciable property, you don't trigger recapture them.
So the problem goes away.
No, the potential for recapture carries over to the person receiving the gift, the deni. If they later sell it at a gain, they have to deal with the recapture based on depreciation taken by both you and them.
Okay, it follows the property. What about death?
Death eliminates the recapture potential. When property is inherited, the heir gets a stepped-up basis, and the depreciation recapture slate is wiped clean. That's a major planning point.
Big difference between gifting and inheriting then.
Huge difference for recapture. Also, charitable contributions. If you donate depreciable property, your charitable deduction is typically reduced by the amount that would have been recaptured as ordinary income if you'd sold it at fair market value.
So the charity gets the property, but your deduction is reduced.
Right. There are also exceptions for certain non-taxable transactions, like forming a corporation, Sec. 351, or partnership, Sec. 721, or certain reorganizations. Recapture potential generally carries over, though gain recognized from receiving boot can trigger immediate recapture. And similarly for like-kind exchanges, Sec. 1031, and involuntary conversions, Sec. 1033. Gain is only recognized to the extent of boot received, and that recognized gain is subject to recapture first. The remaining potential carries over to the replacement property.
Those exceptions are really important, especially for gifts, inheritance, and business structuring.
Absolutely. They require careful consideration and planning.
The materials also mention special recapture provisions. Briefly, what else is there?
Just a few more targeted rules. For corporations selling depreciable real estate, Section 291 might create some additional ordinary income recapture beyond what 1250 does. Basically, 20% of the difference between 1245 recapture and 1250 recapture. Also, Section 1239 says if you sell depreciable property to a related party, like a controlled corporation or family member, any gain might be treated entirely as ordinary income if the buyer can depreciate it. Prevents generating capital gains while keeping the asset in the family with a higher basis.
The related party rule.
Yes. And finally, Section 1254 deals with oil, gas, and geothermal property. If you deducted intangible drilling costs, IDCs, some or all of the gain on selling the property can be recaptured as ordinary income to the extent of those IDC deductions.
So more specific rules for corporations, related parties, and oil and gas. Good to know they exist.
Exactly. They address particular situations.
Lastly, how does all this, the 1231 gains losses, the recapture, get reported on the tax return? It sounds like a lot of moving parts.
It is, and it flows across a few forms. Generally, Form 4797 sales of business property is the main hub. The ordinary income from Section 1245 and 1250 recapture gets reported there directly.
Okay.
The casualty and theft netting we talked about, that often starts on Form 4684, casualties and thefts. If there's a net gain from that preliminary netting, it flows over to Form 4797 to be included with other 12941 transactions.
Right.
Then, on Form 4797, you do the main Section 12301 netting. If there's a net gain, you apply the look-back rule. Any amount recharacterized as ordinary income stays on Form 4797. The remaining net Section 12331 gain, the part treated as long-term capital gain, then flows over to Schedule D of Form 1040.
To be combined with other capital gains and losses.
Exactly. And if the overall result on Form 4797 is a net Section 1231 loss, it's treated as an ordinary loss and generally deducted elsewhere on the return against ordinary income.
That clarifies the flow. Form 4684 for casualties, Form 4797 as the main processor for business property sales and recapture, and then Schedule D for the final capital gain piece. Thanks for breaking down 1231 and recapture.
You're welcome. It's definitely a complex area.
So we've really covered a lot of ground today. We've undertaken quite a comprehensive exploration of the tax side of property transactions, from those basic capital gain and loss rules right through to the more specialized areas like Section 1231 assets and depreciation recapture. Hopefully, you now have a much more solid understanding of how these intricate rules can affect your tax situation or perhaps the situations of clients you advise. Remember, the key things seem to be classifying the asset correctly, knowing how it was disposed of, and cracking that holding period. Those are really critical determinants. And the interplay between these basic concepts and those recapture provisions 1245, 1258 can be complex, but understanding the main principles is just paramount. That Section 1231 treatment for business assets really does offer a unique potential advantage, doesn't it? Turning losses into fully deductible ordinary losses and gains into lower tax capital gains. But as we saw, the recapture rules act as that important check, ensuring those prior depreciation deductions often come back as ordinary income when the asset's sold. We also touched on some strategic implications, things like timing asset sales for holding periods, how recapture affects charitable gifts, those related party rules, all vital parts of tax planning around property. As you continue exploring taxation, just remember that the details really, really matter. While this overview gives a strong framework, every transaction needs its own careful look at the specific rules. So maybe a final thought to ponder. What specific types of assets do you own or might you acquire? And how might these rules, capital gains, 1231, recapture, apply when you eventually sell or exchange them? Something worth reflecting on.